This S&P 500 chart shows the blue line hitting record highs, suggesting an economy at peak strength. But follow the red line below. This is consumer sentiment, the public's assessment of their financial health. It has plummeted to an all-time low. We are watching a broken dashboard. While financial headlines broadcast stability, the material world feels strained and coiled, as if it is waiting for a single crack to set off a chain reaction. This convergence of energy shortages, sovereign debt, and social stress is a polycrisis. It is the moment when multiple systemic failures collide simultaneously, rather than unfolding one at a time. Overwhelming investor optimism currently masks these overlapping failures. Recognizing this disconnect between the narrative and the math is the only way to prepare for the inevitable break in the system. The stock market has largely detached from the broad economy. It no longer functions as a measure of national health, but as a highly concentrated wealth bubble. This chart shows the information technology sector as a percentage of the S&P 500's total value. Tech now accounts for 37% of the entire market, surpassing the levels seen during the dot-com bubble. Because most stocks are held by the top 10% of earners, this tech-driven bull market only fuels a small sliver of the population. This top 10% now accounts for roughly half of all consumer spending in the U.S. This graph illustrates the reality for the other 80% of Americans. Since 1990, the purchasing power of the dollar has collapsed by 150%. You now need $250 to buy what $100 bought just 3 decades ago. This pressure is visible in retirement data. The dark teal line on this chart shows a sharp rise in 401k hardship withdrawals. People are being forced to liquidate their future savings just to pay for current necessities. The booming economy is a financial mirage. Beneath the soaring stock indices is a consumer base that has been exhausted by inflation and is now living paycheck to paycheck. In previous eras, governments used bailouts and stimulus packages to spend their way out of trouble, but the tools used to manage those past crises have created a new, massive obstacle. This tree map visualizes a world of debt. Global government debt has reached $111 trillion, and as the largest block shows, the U.S. accounts for over 34% of that total. Financing this debt is becoming more difficult. This chart shows U.S. Treasuries held in custody at the Fed for foreign accounts. That steep drop at the end indicates that foreign governments are pulling back from funding U.S. debt. At the same time, the cost of borrowing is surging. These 3 charts show 30-year bond yields for Belgium, Germany, and the UK hitting decade highs, which dramatically increases the cost of refinancing existing debt. When the polycrisis strikes, governments will find themselves financially paralyzed. The high debt levels and rising interest rates have left them with no room to maneuver or absorb a new global shock. While financial markets deal in abstractions, the physical world is governed by energy. Current oil prices are being kept artificially low by a narrative that ignores deteriorating market conditions. This chart shows a collapse in Japanese crude oil inventories, the result of a massive drawdown of strategic reserves. Similar drawdowns are happening globally to mask a physical supply shortage. The physical bottleneck is clear in this data. Traffic in the Strait of Hormuz has essentially stopped, with east-to-west tanker crossings falling to near zero. This leads to a mathematical threshold known as tank bottom. It is the point where usable capacity is consumed and temporary reserve buffers are completely empty. Once we hit that floor, the outcome is nonlinear. Rapid price spikes to $150 or $200 a barrel would force refineries to shut down, as the cost of inputs becomes unsustainable. Oil is the unsubstitutable foundation of the macro system. An energy cliff doesn't just mean expensive gas. It stops the production of petrochemicals and fertilizers, effectively halting global agriculture. The causal chain is set. A physical energy cliff will trigger a massive inflation shock, which will inevitably shatter a stock market propped up by only a handful of shares. This systemic collapse will fall on a population with exhausted savings, overseen by a government too crippled by debt to offer a meaningful bailout. We have seen this gap between narrative and reality before. For months, media reports repeatedly announced an imminent deal in the Iran conflict to keep oil prices low, even as physical tanker traffic remained at a complete standstill. Relying on virtual perceptions over physical reality has sidelined the competence required to maintain material systems. We have built a leadership cohort skilled at managing internal relations, but perhaps incapable of managing the material supply chains civilization depends on. The ice is already cracking. Surviving this landscape requires us to look past manipulated financial dashboards and start paying attention to the physical realities that actually govern our world.